Hello and welcome to the August 12th, 2022 edition of Watching the Tape. I would imagine that each and every one of you has an appreciation of the importance of expectations in your everyday lives. Whether you've got an upcoming trip to visit the in-laws for the weekend, or, and this just happened to me yesterday, you are about to take the first sip of a smoothie that your 7-year-old daughter made all by herself. In the case of the smoothie, my expectations were not low enough, and my initial reaction was to blurt out that it tasted like medicine. Of course, I regretted that instantly, but my daughter didn't seem all that bothered by it. She seemed to roll with it, which tells me that her expectations about my reaction were very low. So good on her. Anyway, surefire way to be disappointed in life is to have unreasonably high expectations all the time. Expectations, of course, are very important in financial markets as well. And I want to focus on Wednesday, August 10th, as a case study. On Wednesday at 8:30 a.m. Eastern Time, the July CPI inflation reading came out, and it was very high, at least in a vacuum, at 8.5%. If you were to see that headline on the national news at 6 p.m., you'd be right to think, my goodness, this is bad. When is inflation ever going to subside? But at 8:30 a.m., the initial reactions in three major markets that we will talk about, those being stocks, bonds, and currencies, the initial reactions were sharp and perhaps not in the direction you might have thought. Why? Because the market expectation for the July CPI reading was higher at 8.7%. So the 8.5% print was better than expected. So interest rates fell, stocks rallied hard, and the US dollar fell against global currencies. So let's go over each one of those and explain the why. So first, interest rates. The new information that came out was that inflation is not as high as expected. So the interpretation is that the Fed won't hike rates as aggressively as expected. And so the reaction is that short-term interest rates fell. So let's go to the charts and think about this is right here, this is the expectation of the number of quarter point hikes that will come out of the Fed meeting in September. And think about interest rates as a way to fight inflation. It's a tool for the Fed to fight inflation as it sort of taps the brakes on the economy. So the thinking is that since inflation was not as high as feared, then the Fed doesn't have to apply those brakes as forcefully. And so what we're looking at here is intraday at 8:30 a.m., the reaction was for investors to reduce or cut expectations for Fed rate hikes at the September meeting. And I'm not as concerned about the number on the y-axis so much as just the sharp reaction to the downside. And let's go to a yield with which people may be more familiar. And this is the yield on the 2-year Treasury. So at 8:30 a.m. on Wednesday, the yield fell from about 3.27% all the way down to about 3.07%. That was the initial reaction. And it did trade a little bit up after that yield-wise, but I'm more concerned with that initial reaction in response to the news that came out that was better than expectations. Let's go to stocks. The new information for stocks was that interest rates were falling. And the interpretation is that that is good for stocks because of the lower discount rate. And the reaction was that the NASDAQ rose 2.6% on the day. That is a massive move for a major index. And I chose the NASDAQ because this is a tech growth heavy index. And when you think about what stocks are most sensitive to interest rates and the discount rate, it is those those growth stocks whose earnings are well out into the future and are being discounted back to today at lower rates. So let's go to the chart here. The NASDAQ does not open until 9:30, and so you couldn't see an intraday move in response to the CPI print, but you can see that it moved up significantly on the open from the prior day's close. Now on to the dollar. The new information was that the Fed won't hike interest rates as aggressively as expected. That's the expectation anyways. And the interpretation of that is that it is bad for the dollar because global investors now expect it to be a lower yielding currency. So the reaction is that the dollar fell against global currencies. And here we go with a chart. Again, it's an intraday chart showing the initial reaction at 8:30 a.m. of the dollar against a basket of global currencies, and it fell, as you can see. So there you have it, the initial reactions in three major markets, along with the reasons or explanations why. So asset prices incorporate investors' collective expectations about the future. So it's most easily illustrated in stocks. So if new information comes out for a company that is better than expected, then the stock price is going to rise. And if that new information comes out that is worse than what is incorporated into the stock price, then the stock price will decline. And it's not limited to stocks, of course. I think one of the really fun things about following the cascade of price changes across various asset classes is that it makes logical sense if you have a really good handle on what the expectations are. It's all about expectations. That's it for this week. Thanks for watching. We'll see you next week.